Local debt has been the star performer among emerging market bonds this year, and its advantage over hard currency notes is likely to persist, according to JPMorgan analysts. The rally marks a break with the past. Bonds and local currencies have underperformed hard currency bonds for much of the last decade, partly as a reflection of the 10-year bull run of the dollar. Analysts, including Johnny Golden and Saad Siddiqui, wrote in a report dated Thursday. Many have a strong run of emerging local markets. Return since the last quarter of last year has raised the question of whether EM local markets can have a long run of outperformance. They said a likely U.S. recession toward the end of the year could lead to more inflows, they added. And the analysts know that so far, despite the outperformance, those inflows had failed to materialize. And ahead of a likely U.S. recession, adding a risky fixed income asset class such as EM local bonds that you have not been much involved with for a decade, it might be a step too far, they said. Latin America, which offers the highest interest rate differentials, is the engine of EM local markets, JPMorgan said, and still the bank took profit on its overweight in Ecuador and remained underweight emerging sovereign credit more generally. They also said they'd gone overweight Nigeria against Kenya in their model portfolio, and what we expect the higher rated portion of the index to sell off more significantly in a U.S. recession, given it has not so far, they said, referring to JPMorgan's EM Big ID Emerging Market Hard Currency Bond Index. Some other recommendations from analysts, incredible, and maybe favor receivers in the front end of the curve given positive inflation dynamics and high real rates. The Chilean non-billion dollars make us bearish Chilean duration. Mexico has appealing real rates, relatively robust external and fiscal accounts, and quieter politics relative to the region. In South Africa, front-end rates priming is substantial, but gauging the SARD's actions has become difficult, and risks are for further hikes. Accordingly, the market could persistently price higher risk in premium, keeping us sidelined. In bonds, chronic fiscal risks in the context of OW positioning are a concern. We see scope for curve steepening.